Welcome back. Fears that China may tighten monetary policy triggered a sell-off in commodities overnight. Copper, oil, and gold all getting caught in the downdraft. Well, Jonathan Barratt is the managing director of commodity broking services, and he joins us now live from Sydney. Good to see you there. Thanks for joining us. So we had the GDP and the CPI data from China yesterday. The GDP number was actually a bit stronger than expected, which you think would be good for commodities. But what everyone's worried about is what China's going to do to get that under control.
Lisa, you're 100% correct. And I think what the market is trying to preempt, remember we're going through this honeymoon period for commodities for 2011 as the market tries to decide whether or not we've got growth stories or contraction stories. And it seems to me the market is actually moving towards contraction in China as a course for that commodities will then take more of a dive rather than strengthening. So the contracting policies in China have affected the markets, and as a result of that, we've seen a tip over in oil, gold, and of course copper, which has come back for some of those record highs.
I'm quite interested in the drop that we've seen in gold because, yes, it has corrected somewhat, but if you look at the performance since the peak in December, it's still not even, it's like, what, 6% down from its peak level in December, and that's not even a real correction. Is it going to go down or up from here, do you think? Okay,
1350 is a technical point, and also in my mind it represents a strong fundamental point for when physical buyers will actually come into the market. Look, if it does take out that 1350, I'd be cautious because it does risk quite a hefty move to the downside. Also, the other concern I have is that people might actually move away from gold as that safe haven because we're now seen as contracting policies of growth, and as a result of that, people might move away from gold and back into some other assets. So it is at a very precarious point at the moment. 1350 is a key for me. If it breaks through that, it does risk a short, sharp correction or a clear out towards the downside. 1320 could be the possible target.
John, what are the prospects for corporate activity this year? Because the perception that I'm getting is that there's far more confidence now in the economic cycle. The big miners like BHP and Rio are more confident then about putting capital to work. Are we going to see any big ticket deals like potentially, I know that potash was abandoned, but are we going to see anything similar this year?
Look, Cherie, I think the whole corporate picture, the whole corporate plays are there. But it makes sense for a lot of the big miners now to really start to ramp up production as much as they can. Because although we do see the potential for growth to stall, you've still got some pretty good prices for a lot of these commodities. I guess one of the keys there is obviously with coal at the moment, where we're seeing a drastic increase in production. And with the recent floods we've had not only in Australia but elsewhere around the world, this commodity looks set to continue to trade higher. So you can see these corporate players injecting more cash in their own production and certainly looking for some more takeover targets to help consolidate their costs. So I think that will remain on the agenda. So I'd certainly be cautious, or certainly like to be look at more of those leverage play in a few of those lesser stocks or intermediate miners, because I think the big guys will come in there.
Jonathan, I'm going to put you on the spot now. We're getting some breaking news coming in about a takeover offer from Regent Pacific Group, offering $345 million for BC Iron. It works out to $3.30 a share. The board at BC Iron, they're actually recommending the cash offer. What's your initial reaction to this news?
Okay, look, I think it's a high price. There's no doubt about it. And when you look at I guess the strength of the bid, it's not too bad. And I think what we're finding is that if there's more consolidation, you have more consolidation in costs. And I think from a shareholder perspective, the bigger you are, the better you are. And I think these sorts of things will continue. But when I look at that, it looks quite solid. And I think, if anything, I would be actually selling out as well.
Is this a knockout bid, though, from Regent for BC Iron, John? Or do you think more contenders are going to come to the table?
Well, look, yeah, Cherie, look, it is a knockout, I believe, just on first looking at it. But you want to try and extract the best from your shareholders. These sorts of plays sometimes work and they don't. I think if I was a shareholder, I'd analyse the bid, I'd have a look at it and just see if I can extract a little bit more value. Given we're at the beginning of the year and our expectations are still high, I think it's not a bad bid.
Jonathan, thank you so much for joining us today.
Okay, have a good day, guys.
Jonathan Barratt of Commodity Broking Services in Sydney, our old friend there.